Hello there, I'm Windermere Real Estate's Chief Economist, Matthew Gardner, and welcome to this month's episode of Mondays with Matthew. The National Association of REALTORS released their data on the US housing market in August, and it contained a few things which I found interesting and wanted to share with you. Now, as you can clearly see here, the number of homes for sale remains at close to historic lows. When adjusted for seasonality, there were just 1.03 million single-family and condominium homes for sale in the month of August. That's down 8.3% from a year ago and the second lowest level in 2023. When adjusted for seasonal variations, there were just over 911 single-family homes for sale in the month. That's down 15% from a year ago and 36% below August of 2019. And the condominium market is not faring any better, with just over 123,000 units available for purchase. Listing activity was down year over year by just over 9%. Now, to give you a little different perspective, this chart shows you the total number of units for sale in the month of August, going back more than 20 years. I think it gives a pretty good indication as to how tight the US housing market really is. Now, I've talked before about the reasons why supply is so limited, and the blame is almost totally attributable to mortgage rates, with sellers remarkably reluctant to move because that would mean losing the historically low mortgage rate they currently benefit from. And as the old saying goes, you can't buy what's not for sale. And this is certainly true in the housing market today. With such limited choice in the marketplace, it's unsurprising to see home sales have plummeted following the pandemically induced surge we saw in 2021. At an annual sales rate of 4.04 million units, that's only 40,000 above the low seen this January, and we are now holding at levels we haven't seen since 2010. Interestingly, single-family sales did see a little jump at the start of this year. They have since pulled back, likely a function of rising financing costs, which were getting close to 7% back in June. But the condominium market, well, certainly down significantly, appears to be somewhat more resilient. And I find this interesting, as we have not seen any palpable increase in listing activity for multifamily units. When prices started to fall in the summer of 2022, many expected to see them continue to plunge in a manner similar to that seen following the 2007 collapse, but that has certainly not been the case. Sale prices have rebounded and remain remarkably resilient, especially given significantly higher financing costs. Although we did see a small drop in home prices between June and July of this year, US home prices are only 1.6% below their 2022 peak. They're up 3.9% year over year and up by 11.1% from the start of 2023. Single-family home prices paint a similar picture, with prices down by 1.8% from peak, but up 3.7% year over year and up by 11.2% from the start of the year. Interestingly, sale prices in the northeast part of the country were actually 3.5% higher in August than their 2022 peaks. And condominium prices are just 0.1% below the high seen in June of last year. Prices are now up by 6.2% year over year and are 11.6% higher than we saw at the end of 2022. Now, of course, the data shown here is unlikely to reflect the recent surge in mortgage rates, so it will be very interesting to see what impact that has, not just on sales, but prices too, when the September and October data is published. Now, my intuition suggests that, even with mortgage rates where they are today, as long as they don't move significantly higher, prices at the national level are unlikely to collapse. But I do see sales volumes pulling back further as listing activity remains very constrained. This chart shows a different way to look at the impact that mortgage rates are having on the market. The dark blue line shows year-over-year home price growth, and the light blue line, that shows the 12-month change in average mortgage payments. Although we did see annual growth in mortgage payments fall to just 10% in June of this year, that's the first time we've seen that since 2021. It has subsequently jumped back up, and this means that a buyer of a medium-priced house in the US is faced with payments that are 26.5% higher than they were just 12 months ago. At the same time, however, home price growth, it's stalled. As I've mentioned in several past videos, I find it unlikely that inventory levels will increase significantly in 2023. But now I also believe that supply will be constrained next year as well, as rates remain at elevated levels. As we know, it is this lack of inventory that has helped to support home prices. However, there is a breaking point. 10-year bond yields are holding at multi-year highs and do not appear to be thinking of pulling back anytime soon, especially given new bond issuances that the country is going to bring to market in order to address our burgeoning debt levels. And it's because of this that I now expect to see rates remaining higher for longer. And the question then becomes, how much tolerance will buyers have if mortgage rates hold where they are today? Or what if they head closer to 8%? Although I'm not expecting this to happen, it is possible. And if it does, then sales will fall further and the underpinning of price stability will certainly be eroded. Well, there you have it. As always, I'd love to hear your thoughts on this subject, so feel free to leave your comments below. Until next month, stay safe out there, and I'll see you soon. Bye now.